So I thought what I would do, I'd give you a little bit of background, the work I did with Professor Siegel, talk about the books, how I got to meet him, sort of the lucky fate of events that got me to meet him, and at the same time he was rethinking a lot of his basic foundations for what he was suggesting. And then it all ties into what Wisdom Tree actually does and the way we run our funds. We're very much aligned exactly with what Selwyn just talked about. We see why he's come to use us. We're very much meeting of the minds and how we think about a lot of these big issues. So Professor Siegel's first book, Stocks for the Long Run, came out in 1994, and I'm going to review some of the most important charts from that book and then how we think that translates to returns. But it was basically Selwyn's chart over the long run, stocks beat bonds. That's one of the major conclusions. And we'll talk a little bit more about that. Now, that came out in 94. He did a second edition in 98. I worked with him on the 2002 edition. I was one of his Wharton students back in 2000, 2001. What's interesting, I got to Wharton in September of 99, and he had just written this article in April of 99. Are internet stocks overvalued? Are they ever? And so he talked about how the internet was changing the world, and that's going to really translate to a lot of different things for the economy, but that you really couldn't justify a lot of the valuations. Now, that was his first article, April of 99. I met him in 2000. He had just written this article, Big Cap Tech Stocks Are a Sucker's Bet. And he listed 9 stocks in here, triple-digit P ratios. He said you can never justify these valuations. Now, if you look at his own portfolio, he was one of Vanguard's very first investors. So he would have had his portfolio, the Vanguard S&P 500 from 1975. I mean, he was never associated with Vanguard, but he said, buy the market, buy it cheaply, Vanguard is the answer. Now I would sit in his office and I'd hear people call him and say, what stocks, sectors do you like? He said, no, I just buy the market. This was the first time he was making a quote-unquote call saying, a huge part of the market is overvalued. And that was 30% of an S&P 500 was in these tech stocks. So his own portfolio started thinking about how do I do things differently. You can't just buy markets that get exposed to all these major bubbles. So he was really rethinking just his main work. I worked with him on this. I mentioned the 2002 edition of Stocks for the Long Run. He'd added a chapter on behavioral finance. I was lucky enough to get to write that chapter for the book. We did it as an interview with a psychologist. The psychologist counsels his client. Here's all these problems I have, and it was written as a very different way than the rest of the book. That was my contribution to the Stocks for the Long Run book, that chapter on behavioral finance. But the book that I spent 3 years working with him on, 2002, 2005, we worked on The Future for Investors. I was really trying to be his answer for that tech bubble. How do I protect from bubbles was the major concept of the book. That the traditional indexes like the S&P 500 get biased to all those. So one of the things we did is we looked at the original stocks in the S&P 500 in 1957 when it was created. And at that time you had 20% materials, 20% energy stocks, you had no technology stocks, no financials, no healthcare. And the idea was if you just bought those original stocks in 57, held them forever, how much did you lag the actual index, which included all these new fast-growing stocks? And the surprising result was not only did you not underperform, buy these old stocks that died, you actually mostly outperformed in the traditional sectors. And it led to what we call the growth trap, that people tend to get very excited by fast-growing new technologies, whether it's individual stocks, IPOs, sectors, fast-growing countries. People get very excited about growth and overpay for it. And it really went towards what we talk about is why we bias towards value as a long-term investment strategy. The other half of the book was on demographics, the future of the economy. There was a big part of that internet communications revolution, how that was going to actually support global growth as the second half of the book. But the final chapter of the book was DIV, directives. D stood for high dividends, value stood for low PE, I stood for international emerging markets, going to be a big part of global growth. So that book came out in 2005. We ended up joining Wisdom Tree and started getting funding in 2004. So I'll go through the Wisdom Tree a little bit more in the next set of slides, but it was very much, we joined Wisdom Tree because it was very much right in line with the research in that book. They were independently created, but so we were there from the beginning when they got funding in 2004. A little bit more to that a little later. Now, the central chart of stocks for long run was this 200-year study where he looked at all the major asset classes. It was the longest anybody's been able to assemble a long-term return series across all these assets. So someone had a 100-year chart. This is what we call the total after inflation, the total real return across stocks, bonds, bills, gold, and the dollar. Now what you see is this long-term trend line where stocks, 200-year compounding of $1 turned into over $1 million. Bonds was $16.49, bills was $2.68. Gold after inflation was only $3. So a lot of people go to gold. Now, that after inflation over the longest period of data you have, it's only did really $3. The dollar, $1 back in 1802 is only worth 5 cents today. So that's the compounding of inflation. Now, the numbers in the top left table, where you see stocks did 6.7% per year for 200 years. Some people would call that Siegel's constant, which is the long-term real return from stocks over all those major periods. Bonds did half of that, 3.5. Bills did 2.6. Gold only did 50 basis points over the long run after inflation. Now, one of the things about that is how consistent that 6.7, 6.6 is, which I'll show in another slide. And the other thing, one of the things that we monitor closely is you see the white line going above and below that long-term trend line. The red line is at 6.7% compounded, the long-term trend line. One of the signs things the market gets really overvalued is when that white line is very much above the trend line. You see the peak near the end, March 2000, that's when it really jumped above the trend line. March 2009 was really below the trend line. Right now you're basically at the long-term trend line. So that tells us there's really no major overvaluation of the markets that you have seen in some of the past periods. One of the things I said Siegel's constant is if you look at all these major sub-periods, so the 200-year data, 6.7, if you break it into long-term periods, 1802 to 1870 was 6.7, 1871 to 1925, 6.6. Some of these are just where researchers have focused on different sub-periods. People sort of question 200 years, can you really trust the 7% return going back 200 years? The 1926 period, which was what Selwyn was showing, they call that the Ibbotson period, which is when one of the other academics assembled a different stock database, 6.7. Since World War II, 6.8. So you see the consistency of that 6.7. And we're going to talk about what drives that in a little bit. Now, just because it does 6.7 over a long period doesn't mean you can't have very long stretches where it's way above or way below. So right after World War II, you had a 20-year period where it did 10% a year. Then you had a 15-year period from 66 to 81 where it did 0, a little bit negative. Then you had the greatest bull market really of all time, 13.6, double the long-term average. Then since 2000 when the market peaked with the tech bubble, did 3.1. So you definitely can't have long-term stretches where it's way above or way below. One of the things Siegel said in stocks for long run was while stocks are the most volatile in the short run, you look at bonds, stocks never had a 17-year period where they were negative. Bonds have had a 30-year period where they've been negative. So while stocks are the most volatile in the short run, Siegel was basically saying because of inflation, bonds can have a negative long-term return. And you may be at a point where that's where you are today. So we're going to talk about that a little bit more. But stocks never had a 17-year period where they lost on inflation. So that was one of the major pieces of research in the book. Now, valuations is a key driver of these returns. So the P ratio that we look at is one of the major things. Now, people say, the market, there's one argument that the markets are expensive today, they need to get back, we never got to single-digit PEs. One of the questions is, when did you ever have single-digit PEs? And the only time you really had that in the last 50, 60 years was when you had double-digit interest rates. So there was time in the 1980s when you had 15% on your 10-year bond. But as Selwyn was saying, today your 10-year bond is 2%. It's a very different environment. So one of the things is, if you look at the average PE over the last 70 years, the average PE was about 17. In the tech bubble, your PE for the market as a whole got up to 30. Now today, if you look at just the S&P 500, PE showed 22. Now I'm going to talk about a few of the biases there, and I'm going to talk about what are the factors that can actually get earnings to go higher. But for the people who think you need to get back to single-digit PEs, we'd say you need an environment of double-digit interest rates to really make that happen. And that's not anywhere in the short-term cards. So don't expect that PE to ever really get back there unless you see a very different interest rate regime. Now, in terms of how do you value the market today, there's all sorts of different definitions of earnings. You hear about things that would call GAAP reported earnings, S&P operating earnings, and they range in estimates. For 2016, the S&P 500 talk about 2360 is the index price. You see different earnings estimates. Most conservative are these GAAP earnings at the bottom, and there the numbers for 2016 was 95.71. Estimates for this year show a big growth in earnings, about 120. And you have what's called operating earnings. S&P has an operating earnings concept. 2016 operating earnings are 106.70. Estimates for this year, 130. So you see a big growth in earnings on the operating side. All these translate to PE ratios. So if you think about what the average PE ratio across time, Bob Shiller is an academic out of Yale, is one of Siegel's best friends. They went to MIT together. They often get paired in these bull versus bear debates, Shiller being the bear more often, Siegel being more of the bull. But if you look at the PE ratio across time from Bob's data, so the average PE ratio was 15. Now, if you do 1 divided by 15, 1 divided by 15 was 6.6. Did we hear that number before? So the reason why stocks did 6.7 is very much related to this 1 divided by 15. The earnings yield of the market over time is very tied to your expected returns on the market. So if we take the earnings numbers that people are estimating for this year, you take the 2360 on the S&P 500. If you take some of the conservative numbers, you would say 2016 operating earnings gives you an 18 times multiple for using the 2017 numbers. So you get between 18 to 22 times, whether you take the most conservative numbers, you're at 22 times earnings, the more aggressive numbers, they're around 18 times earnings. So use the P of 18, 1 divided by 18 gives you a little bit less than a 6%, a little bit more than a 6% return. If you do the 22 times, you get a little bit less. But one of the keys is, if you think about that stock versus bond trade-off, a 5% earnings yield, even if you took a 20 P ratio, so it's lower than the long-term average, right? The long-term average is at 6.7. If you do 1 divided 20 and a 5% earnings yield, that's still better than your comparable alternative set in that stock versus bond model. The equity premium Siegel had, stocks versus bonds long-term was 3%. Today, stocks versus bonds is even better than historically. Even though US markets are more expensive, which means a little bit lower returns. But bonds are much more expensive than they have been historically. Now, one of the things that, and we're here, it's an interesting day to be talking about this slide, the impact of tax reform. And we're supposed to be hearing Trump's ideas for tax reform today. So an interesting day to be talking about this. How much can tax reform actually improve the valuation of the market? On the left, we show the S&P 500. Middle is the mid caps, right is the small caps. We took the S&P at 21 times earnings. We did some modeling to say, if you take, Trump says he wants a 15% tax. Paul Ryan says 20%. So we're going to negotiate what does the actual tax rate get down to. But if you so we did some modeling with a 25% corporate tax rate down to a 15% tax rate. And on the left is the S&P. You go from 21 times earnings, current PE. If you got down to a 15% tax rate, that could be a 3 PE multiple point reduction, going from 21 times to 18 times. If you only got to a 25% reduction, you still improve from 21 to 19. So that does help you on valuations. I mean, Professor Siegel always says, we want Trump to focus on taxes. That's one of the things why the market has been robust. Talk about corporate taxes, it makes the market cheaper from that perspective. Now you see small caps here had a higher multiple on the S&P 600. That has the biggest benefit from reduction, partly because large caps, you get companies like Microsoft, Apple, Google, a lot of foreign revenue, they pay less taxes on their foreign business. Small caps, more local to the US economy, they get more of an impact from tax reduction. So you should see the earnings improvement for mid caps, small caps improve more so than large caps. Now I'm going to talk about a few things biasing all these numbers higher. Why is the mid and small cap have these much higher PEs than large caps. In just a few slides. One of the things on where valuations are today, and so if you took the S&P current estimates for this year 18 times, last 12 months 22 times, going forward these show 16 times, all the international markets are at lower PEs today. So most US investors, we tend to have this home country bias. We're from the US, we overweight the US. When you look at valuations around the world, Europe, Japan, emerging markets, they tend to be at lower valuations than the US. So if you take that earnings yield model as a predictor of real returns, you might say that the foreign markets have a better opportunity set from that earnings yield model. And there the bond yields are even lower. So you could say in that stock versus bond trade-off, that's one of the things that make these international markets a very attractive from a valuation perspective today. This is a chart on the PEs across the US. IFA is your developed international markets, that's your Europe and Japan. And the emerging markets, green line, that's your China's, India's, Brazil's. And EM, because they are more riskier, and they do have a lot, whether it's political risk, currency risk, they should sell at a lower multiple, but that lower multiple should also translate into better returns over time, going back to that earnings yield versus that earnings yield model. Now, when you have pessimism, to Selwyn's quote, a lot of people have been pessimistic with Europe. You see we had the French elections on Monday, and then the markets are up 3 to 4%. Right? So that's a lot of the things that get translated, but still those European markets are at a lower valuation, partly because people are very still pessimistic, a lot of these international markets. So now why did the PE ratio, is it higher? What are the things that's biasing the number higher than it ought to be? And about 10 years ago, Professor Siegel wrote this article called Beware of the Aggregation Bias. And we said the S&P gets its earnings wrong. And we gave a simple two-stock example to why S&P gets its earnings wrong. And it looks at, assume you have this healthy firm A that had 10 billion of earnings, had a 15 P ratio, so had 150 billion market cap. Then you have this sick firm B, 9 billion in losses, 10 billion market cap. When they show these P ratios of 22 times on the S&P 500 that we talked about, what they do is, you say the first firm has a 15 P ratio, the second firm has an infinite P ratio, has no earnings, all losses, 9 billion of losses. What's the P ratio of the aggregate portfolio? Well, your portfolio in a cap-weighted index would be 94% invested in the 15 P ratio, 6% invested in the firm with losses. So what is the actual PE? Well, the way they traditionally report earnings, they add up the market value, so 150 billion plus 10 billion gives you 160 billion. And they say 10 billion in firm A, negative 9 in firm B, so they have 1 billion in profits. It's a 160 P ratio, which is really nonsensical. You're 94% invested at a 15 P ratio. So when you have firms with a lot of losses, right now, the energy sector, because oil collapsed, a lot of the oil companies have losses. So what ends up happening is that gives you a distorted P ratio. So one of the things WisdomTree does is we have a earnings-weighted index family, and one of the strategies I know RVW uses is one of our earnings-weighted approaches. But the earnings-weighted approach, one, it gives you a lower P ratio across time. We launched the earnings family 10 years ago. This shows the discount in PE across time. On average, we tend to be 15 to 17% cheaper over the last 10 years compared to a market cap index like the MSCI or S&P 500. Today, it's about 27%. It's an extra 10% cheaper because we don't have the unprofitable companies. So that translates to 2 PE multiple points for the S&P. So 22 times goes down to 20 times if you just kick out those firms with losses. So that aggregation bias shows up in large caps, but it shows up in mid and small caps even more. So if you look at the mid cap index that we have, the average discount has been about 27% when we do our earnings weighted approach versus the cap weighted approach. Today it's about 35% lower PE than a traditional cap weighted index. And again, that's because of the losses that are biasing those numbers higher for the traditional cap weighted indexes. Now, one of the things that's driving all these markets is just how interest rates have collapsed. So the 10-year TIPS bond is one that we say the 3.5% I showed on the first slide, that was your after inflation real return. Well, the 10-year tips, the yield on that is a good reflection of what should you expect bonds to give you after inflation for the next 10 years, looking at that 10-year tips bond. Back in 2000, that 10-year tips was 3 to 4%. That's when the S&P had a 30 PE and a 3% earnings yield. That would have been a good time to be doing tips. Today, the 10-year tips is 40 basis points. So, and there was a time when it was negative. Now, what did that mean when it was negative? It was as much as negative 1%. People were saying, I have $100, I'm going to give it to the US government, 10 years later, take $90 of purchasing power back. Why would you do that? So that was a world of 2013, not so long ago, that valuations were extremely bad on these tips, but people were going for safety. They didn't trust a lot of banks, and the 10-year tips was one way that people were reflecting that. Even at 40 basis points, if you could say, I'm going to hold a portfolio of stocks yielding 2 to 3%, dividends grow over time, with inflation, we'll show some of that, versus the tips at 40 basis points, I think it makes the compelling case for stocks today versus bonds. Now, we think of the US as being low yields. One of the most amazing things is we're actually one of the highest yields compared to the international bond market today. These are comparing, the green line in this chart is the US versus Germany and Japan's 10-year bonds. So we have a 230, 240 10-year bond today. Japan's 10-year bond is 0. Germany's 10-year bond is 30 basis points. All right, so one of the pressures keeping our rates from going higher is just, if you're a Japanese pension fund and you can get 0 in your 10-year bond, if you buy the US 10-year bond at 2, you're doing that a lot. So it is a global yield environment, and I think that is one of the constraints, is not just US investors, you have global investors coming to the bonds. And I talked about the tips in the US getting negative. Why would you do that? Well, across Europe, from 2 to 5 years, they had negative yields across all their fixed income markets. If you look at the German 2-year bond yield, people are paying negative 85 in Germany today. In Japan, it's negative 30 basis points over 2 years. In Japan, it goes out to 7 years where they have a negative bond yield. So this low interest rate environment is likely to stay for quite some time. Now, why is it, a lot of people say these central banks are forcing interest rates to 0. Now, this is one where we get into a lot of heated discussion with some people. Professor Siegel says it's not central banks that are keeping rates near 0. We're lucky the central banks are following rates down to 0, because if they were trying to keep rates artificially high, then we'd be in a lot more trouble. But the central banks are following real economic forces. We have slower growth, we have more demand for safe haven assets, increased risk aversion with the demographics, just people not wanting to take as much equity risk. And then bonds have been a hedge for equity portfolios. So all these things are causing very low rates today. Now the question is, where will these go in the next cycle? Bill Gross termed the phrase new normal. They also have new neutral. Neutral is sort of in the central bank discussion, where will the Fed set their short-term interest rate so that it's neither too right now they say they have a very accommodative monetary policy, and they're removing some of this extraordinary monetary policy. The question is, where will they at the end of this cycle? It's what you call the neutral rate. And so Gross has said he thinks the neutral rate is now 2%. What's important is the Fed has said their neutral rate in the past is going to be 4%. So will it just be much lower than normal? Professor Siegel is on the belief that we're going to get to 2% at the end of this hiking cycle. Now, what does that mean for long-term bonds? You've had some people on the FOMC, which is the group that sets our monetary policy. James Bullard is one of the presidents of the St. Louis Central Bank. He said the new neutral today is 70 basis points, which is where they are today. But the Fed has started reducing their forecast from 4.5% down to 3. We think they're going to keep reducing it down to 2. So what does this mean for the long-term bond? If you say the long-term bond should have a premium over the short term, there'd be a 1% premium. If If you get 2% on the Fed funds rate, maybe you get 3% on the long-term bond. It's a very different cycle than you've had historically, which means very poor prospects for just traditional fixed income portfolios. So the question is, what do you do for income? And that's where we do think dividend-paying stocks give you that cushion ahead of inflation. If you look at the long-term data on dividend growth on broad market indexes like the S&P 500, last 50, 60 years, that study on the S&P 500, inflation's been 3.7%, dividend growth has been 5.6%. So you got 2% ahead of inflation from dividends growing on the markets. In high inflation decades, we had the 70s and 80s, inflation was 6% a year, dividend growth was 6.5%. We've had this lower inflation the last 30 years, 2.5%, dividend growth has been about 5%. So dividend growth is a key part of the market. So if you get a 2% yield today from a broad index, you get 5% growth. 2 plus 5 is 7, and that's one way to think about what are your return expectations from stocks. Getting the yield and you get that future growth. You can see this dividends is a fairly stable line. You don't tend to see a lot of declines in dividends. We did see in 2008, 2009, a 20% decline in dividends. It was your first double-digit decline in 50 years. And what was that? It was the financial sector. So there was a financial crisis. A lot of the banks cut their dividends in 2009. But within a few years, you're now well past the peak in dividends from where you were there. And I have a few other slides on that in another presentation. But that sort of wraps up my Professor Siegel slides. So that's the Siegel background on some of the research I've done with him, some of his views on the markets, and he let me borrow some of those slides. For the Wisdom Tree side, just a brief background here on the company, so you understand our background a little bit more. Today, Wisdom Tree, we manage about $40 billion in assets. We have about 200 employees. We're now becoming more of a global firm. We launched our first set of funds in 2006. So we got fundraising from Michael Steinhardt, who's one of the big hedge fund investors. He had done a lot in hedge funds. He's done a lot with the Birthright to Israel program. He's the one who founded that group. But he had retired, closed his hedge fund in '94. Hadn't done anything in investing until he backed the firm, Wisdom Tree, in 2004. Professor Siegel joined as a senior advisor. I joined as their third employee. So we've been there from the beginning of when they got started. We now have offices around the world. We have a group in London, a group in Canada, some people in Tokyo, as well as some sales offices in Latin America. Now, our belief compared to sort of the future, it's very reflective of the future for investors of believing low-cost indexing, but also believing that you can rebalance away from bubbles like the tech bubble. Trying to protect from that is at the core of what we're trying to accomplish throughout our portfolios. Our research team is a big foundation of what we do. We have 20 people across equity research, fixed income research, investment strategy. CEO was Jonathan Steinberg. He had a magazine, individual investor group, when he was first starting to do index research. And he's still our CEO, runs the firm there. With that concept of how we're trying to rebalance portfolios, the key that differentiates us from a market cap index, the S&P 500 market cap is price times shares outstanding. It's really a momentum index. Stocks go up in price, they never sell, they never buy when things get cheap, and we're trying to, once a year, rebalance back to a sense of value using a different weighting mechanism than just market cap. That's the core of what we're trying to do. Some people now call it smart beta, call it factor investing, but the key is trying to use a rules-based process to add value. Now, I alluded to dividend yields and dividend growth as a key driver of returns, and that is just a mathematical decomposition of your return. Your return is really two pieces. You have your dividend yield that you're getting, then you have the price change. So the average dividend yield is an important driver of returns, but the price change can equally be thought of as what is your dividend growth on the market, and then is the market getting more expensive or less expensive? So that is one of our strategies. You can think about dividend weighting as increasing your current dividend yield, getting a higher average reinvestment. That is one of the things to help drive returns. And we do weight by dividends to try to increase the yield to do that. Then we also have strategies that try to help increase the dividend growth on the market. And there we look at factors like return on equity, return on equity is one of the factors we have found. Warren Buffett, if you read Buffett's annual letters, Buffett says there's 6 criteria we'll use to buy any company. And one of his 6 acquisition criteria is high return on equity with little debt. And so we've tried to bake that into some of our methodologies, as we believe that is a key driver of dividend growth, which we think is a key driver of long-term returns. So if you look at the S&P 500, I showed the cumulative dividend growth of the S&P 500 over time. This compares some of the recent trends on dividend growth as well as the recent total returns. Now, one thing, if you look back to 1957, the market did about 10% a year back to 1957. The dividend growth was 5.7. Now, if you said what was the average dividend yield over that period, the average dividend yield was probably 3 to 4%. Today, the dividend yield is 2% on the market. So what happened if you took that 3%, you added the 5.7, more like 8 to 9. So how did the market do 10? Well, stocks on a dividend yield basis did get a little bit more expensive over that last 60 years. Now, if you look at the short term, the last 3 years, 5 years, 10 years, even the last 20 years, the markets haven't really been getting more expensive the last 10 to 20 years on a dividend basis. If you look at the 10-year total return, the total return was 6.9. The dividend growth was 6.4. You had an average yield of about 2% over that period. So you take the 2%, you add to the 6.4, and markets got a little bit cheaper on a price to dividend basis. On a 5-year basis, people say it's just been the Fed. The Fed's been doing all this monetary policy. They're driving the markets. But we did 15% a year over the last 5 years, but dividend growth was 12% of that. 12% per year was driven by dividends. So the markets on a dividend basis really didn't get that much more expensive over the last 5 years. 3 years, dividend growth was 9.7% a year. Total returns were less than 9%. And you had a 2% average yield. So, for people who think it's just being driven by these central banks, we think, no, it's actually being powered by dividends in the short run. We do think you can get 6 to 7% dividend growth going forward. So that is one of the key things supporting the market. Now, how dividends have changed, one of the interesting things we look at one point, financials were the only negative bar on this chart. And for a while, they were a big drag on dividends. You can see the orange line on the right is financials. Since 2009, have been the fastest growth in dividends because they cut during the crisis, but now they're coming back. So companies like Wells Fargo, JP Morgan, they're back to being top contributors to total dividends. On the left is the new thing, technology. Apple, Cisco, Microsoft, all these companies have been growing dividends, and they're the fastest growth in dividends over the last 10 years. I mean, since we launched, when we first launched our large cap dividend index in 2006, tech was 5%. It was actually one of the lowest dividend paying sectors. Today, tech is the biggest dividend paying sector in our large cap index. So that is one of the shifts in terms of how you think about where dividends are coming from. And we try to body this into a methodology to not just look backwards. Because if you just look backwards and say, have you been raising your dividend every year for, say, 10 years or 20 years? Some of the competing index methodologies do that to try to identify a dividend growth portfolio. Well, you're going to miss on these tech companies. As an example, one of our main competitors says you have to raise your dividend for 10 years before they would consider you a dividend growth stock. Well, Apple, before they will ever add Apple, which is now the biggest dividend payer in the world, it'll be 2023 because it just started paying in 2012. And so we try to say, how can we identify these stocks ahead of time? So one of the ways we do that, I mentioned the Warren Buffett model, think about high return equity with little debt. You're seeing people like Jeremy Grantham, who has a money management firm out of Boston, also focus on these types of metrics. Some of the other index methodologies are also looking at that. And in terms of these long-term return charts, Selwyn had a few long-term return charts. This looks at operating profitability, which is very much like our return on equity concept, and it shows the lowest operating profitability tended to underperform the long-term market, the highest operating profitability and outperform the market. And systematically, we designed indexes to how do we tilt or select those in the highest operating profitability buckets. So we bake that into a rules-based process to try to get you those highest profitability companies, which we found have been rewarded over time. So just as an example, in our quality dividend growth index, that is one that RVW is using, we start off with all the publicly traded companies. There's 3,600 publicly traded companies in the US. We narrow that down to first, do you pay a dividend? That brings us down to 1,430 companies approximately. And then we say, let's look at these metrics that we believe lead to better dividend growth over time. Higher return on equity, high return on assets, earnings growth expectations. So we select the best combined metrics. We weight them 50-50 quality and growth. We weight back to the dividend stream. We create a portfolio of 300 stocks anchored to that. And that's what we would call our quality dividend growth index. We think that will have better dividend growth across time. And that's a large cap oriented portfolio, but we do this in every region. So we do the same thing for small caps, we do the same thing for international, emerging markets, very consistent process across the world. That index today is about 4 years of live history. It's one that we didn't have in 2006 when we launched, but some days we were looking at the markets we developed in 2013. Compared to, I mentioned one of our competitors who says you got to raise your dividend every year for 10 years. That's who we benchmark against. It's a NASDAQ index. We're certainly very happy with the results in the 4 years that index has been live. We've been doing pretty well versus our benchmark, or in the blue line, the benchmarks in the orange line. Now from a forward-looking return expectation, a lot of numbers on this chart, but the basics is that I would say our quality index today is at a cheaper multiple than it should be. So high dividend stocks usually are at a discount to the market, but because of this whole search for yield around the world, people are going towards safe yield in the US, whether it's telecom stocks, REITs. There's a big drive for yield, and people are discounting quality more than they usually do. Usually, if you look at this high dividend quality, you look at the emerging markets, you look in the developed world, you pay a high multiple for quality. In the US, you do not pay a high multiple for this quality basket. Now, one of the things about how rates can really drive these things, we showed last year the difference in sectors when you have a falling rate environment and a rising rate environment. We haven't really been in a rising rate environment for quite some time. But last year, the 10-year went from 230, bottomed on July 8th of 130, then it shot back up towards the end of the year. In the first 6 months of the year, what happened? Any of your bond proxy sectors, so telecom utilities are bond proxies, the first 6 months of the year, those two sectors were up 25%. Then rates moved, they doubled almost by the end of the year. And then you have, if you look at the bottom table, real estate, utilities, consumer staples, healthcare, some of the high yield sectors had negative returns as bond prices rose. So the way to think about our quality dividend growth, it has no utilities, no real estate, no telecom. So it's less in those most interest rate sensitive stocks. It's more in things like tech, industrials, consumer, which we think should do, they're just priced better today, but they're a little bit less interest rate sensitive than some of those bond proxies. And I'll just quickly touch on one other strategy. I showed the earnings weighted approach earlier. One that we have done that I think RVW also likes a lot is our mid-cap earnings approach. Instead of weighting by market cap, it weights by earnings. We'll get you that lower P ratio. The way we narrow that universe down, we start with all the profitable companies in the US. So we screen out those unprofitable companies. There's a quality bias to our portfolio. Start off with the same 3,600 public companies. We narrow down to those who have positive earnings, around 1,900 companies. Then we focus on the mid-cap segment. So we take the 500 largest out. That's our large cap index. We get the mid-cap index as looking at just the market cap characteristics. We wind up to about 600 mid-cap companies that have positive earnings. We back to that earnings stream once a year. That valuation discipline. This is a chart from the Siegel's book. Low PE outperforming the highest PE type stocks over 50 plus years. The low PE stocks did 4% better than the highest PE stocks. The highest PE stocks underperformed the market by about 200 basis points. Lowest PE stocks outperformed, and that mid-cap index is going to tilt you to those low PE stocks over time, which we think has been rewarded from our research. And the key is rebalancing back once a year, every December. What you're doing is things that are rising in price, if their earnings aren't rising, they're going to sell. Things that are falling in price, If your earnings were stable, you're going to add. There's that once-a-year process that says the more expensive you're getting on a PE basis, we're going to sell you as you're getting more expensive. We're going to buy as you're getting cheaper. Once you're disciplined to do that, and that's something that market cap indexes don't have, and that's how we think we help protect from the bubbles. I started off with Professor Siegel's book. Now, if we ever did get a rising interest rate environment that changes, this mid-cap index will actually, I think, be one of the strong beneficiaries. In the 10 years we've had this index out, we show how it's done compared to the market and versus other competitor indexes. Some of the best performance has been during rising rate periods. So I think this is one, you think about, where should I be if rates do actually move up? Many small caps have been some of the best beneficiaries, and particularly our mid-cap earnings index has been very good for that. Track record on this index has been very, very strong. I don't have the active manager chart here, but if Selwyn's chart on mid-cap active managers has been, an index has beaten 90% of the active managers. This may be the single top performing mid-cap fund in the last 10 years. So this is one where it's got a rules-based process, it's an index. It's literally beaten maybe all but 2 active managers over that period. So this is the embodiment of that. Having an index, having a rules-based process can beat the vast majority of all the active managers. Now, I started off with the cap-weighted PEs. Here, if you took our earnings-weighted PEs, we saw numbers like 18 to 22 times on the S&P 500. In our large cap basket, our current PE is 16. Our mid cap basket, our PE is 17. Our small cap basket, the PE is 16. If you remember, the cap weight indexes were like 22, 25, and 30. So the difference between 17, 25, and 30, much more reasonable valuations on our earnings weighted approach, and that's pre-tax cut. So if you got the 25 or 15% tax rate, you could see that mid-cap and small cap with PEs of 14 to 15 times, which is very normal valuations. Actually, we say cheap valuations for US parts of the market. So as we're here on a day where Trump's talking about taxes, doing this tax rate sensitivity is sort of an interesting look at the markets. I'd say, even pre-tax cut, the valuations are 16 to 17 times on these earnings weighted approaches. They're normal valuations. But if you get that tax cut, everybody wants to focus on that sooner than later. That would be another big positive support for the markets in these in particular. So that's my final slides there.
Thank you so much. Jeremy, thank you so much. Folks, what Jeremy really did was take you under the hood, because the takeaways